Warning. This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. All right, hello and welcome to Camel Finance. I'm your boy Camel and welcome to the week. Welcome to Monday. In today's episode, I am going to run through some very important bits of data that are coming out this week, and then I'm going to show you something where I believe I have finally solved the issue pertaining to Bitcoin's cycles. I think I've finally cracked the cycle code with the help of a bunch of the Camel Crew, so make sure you stick around to see that because this is true alpha. You're not going to get this alpha anywhere else. I think this week is going to be a pretty big week, to be honest. And the reason I say that is tomorrow, Tuesday, we have got the US PPI data coming out. Okay, so that's not nothing. That is going to give us some gauge on whether or not inflation is going to continue to be sticky or perceived as sticky by the majority of the market, or whether indeed we are going to start to show what I have been calling for a long time, which is that we are going to continue to see disinflation, okay? Continue to see inflation come off. So we're going to get a hint about that on the Tuesday. And then on Wednesday is the big dog, okay? Wednesday, we have got the US CPI data due to be released. So that's going to be very, very, very interesting, particularly for the Camel Crew, who are very contrarian in their stance, expecting continuation of disinflation rather than sticky or hotter inflation prints. Now, with all that said, of late, we have made it a thing to go live for the CPI data release, so I will probably do that. Don't hold me to it at the moment because I'm still not 100% sure I can commit to it, but if I can, then I will. For anyone that's thinking, why on earth are the Camel Crew calling for lower CPI? It's essentially twofold, okay? I think anything you do to the M2 rate of change shows up in the CPI with about an 18 to 19 month lag. So we've had down, sideways, and then down in M2, and so far with a lag, we've seen down, sideways, and I now believe we have started to see this portion, okay, the final leg down, start to show up. So if that's going to hold true, then we really better see some cold CPI prints ASAP. Trueflation currently has us at about 1.5% for the CPI print. Now, this is live real-time data and is typically a full month ahead of the US government's reported rate. So I'm by no means suggesting we will see a 1.5, okay, at the next CPI print on Wednesday. I'm by no means suggesting that. But I am suggesting we really ought to be on our way down towards that. And I would think that we are probably going to see a 2 handle. And moreover, and this is the most important thing, at the next month's readout, I would really expect to see a true and genuine drop-off in the CPI curve, okay? So we can maybe tolerate one ever so slightly flat print this week, but then next month, I would really start to expect to see, if I am correct, okay, if I'm not wrong, then we should start to see this thing really accelerate and start to look just like this, okay? So CPI should start to really become very quickly and rapidly disinflationary if this whole idea is right. So I do expect a colder print. And of course, the CPI data is always tough to navigate since they're constantly changing the calculations and tweaking it. And it's got a bunch of lagging components like shelter. But I think the reality is, as always, we're going to continue to look through the data. We're going to continue to focus on the trend rather than the initial prints. And most importantly, we're going to continue to look into the future for what we should expect to see play out over the coming months, rather than just look right below our noses at the current data, which is what the rest of the market does. So we've had a very good track record at seeing down, sideways, and down, okay? And I expect this to continue to play out. But if that's true, then like I said, we really do need to see some continuation of disinflation this week, and most importantly, next month as well. So the signs are there for trueflation, for now at least. That's good. We've also been using this TMC Global Credit Impulse, which is in orange, and you can see that leads US CPI by about 18 months. This has also been telling us to expect continuation of disinflation before ultimately a short period of asset price deflation. So once again, if this is not wrong, and I don't think it is, then we really need to see the CPI start to come off rapidly over the next 2 prints. The Camel Crew is also very well known, increasingly well known, for telling it to the bond market, okay? And what I mean by that is a lot of people thought that there's no possible way we could be seeing rate cuts anytime before November. It was only a couple of months, maybe even less than a couple of months ago, that people were actually calling for an additional hike, okay? Because again, they are looking right in front of their noses at what they thought was sticky inflation rather than looking into the future. As it currently sits, the CME is pricing around a 50-50 chance, 50% probability that we see a 25 basis point cut and a 50% probability that we see a 50 basis point cut at September 18th FOMC meeting. Needless to say, the CPI print and the data that comes out this week is going to heavily influence the way this reprices, and so we're going to continue to monitor this in real time. And speaking of tell that to the bond market, of course, we are still operating under the understanding that it is actually the US 2-year yield, it is the bond market that determines when the Fed cut rates. It is not the Fed that is in control, it is the bond market in aggregate that is in control of telling the Fed when to cut. And when the bond market, specifically the US 2-year yield, starts to move lower, okay, what we see, historically speaking, in every other case is the onset of a Fed cutting cycle shortly thereafter, okay? We've seen this in every other case, as you can see here, 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 and here. And, of course, this chart was put out in April. Now, as it stands, if I draw your attention to this low right here, okay, we are currently trading below that low. So here is the low that I was talking about, and as you can see, we have significantly moved back below it. We are now possibly working on, if I draw some kind of horizontal line in here at the lows, probably looking at breakdown, retest before resumption to the downside. And again, if this is going to continue to happen, this is the bond market trying to force the Fed's hand at cutting interest rates. The bond market seems to agree with the Camel Crew. And what I mean by that is the bond market seems to think that inflation is not sticky, and that unemployment is getting out of control, and that we are walking dangerously close to a recession, and thus the Fed is already too late to start cutting, which again speaks to the bond market trying to force the Fed's hand. It's going to be a big week for the Camel Crew. Like I said, inflation is sticky, is what everyone else thinks, okay? And higher for longer in terms of rates is also what everyone else thinks. I suspect by the time we get through this week, a lot of people are going to realize they've been on the wrong side of the trade for a long time. Something else the bond market is out here signaling, okay, is there will be no soft landing. There will be no landing, okay? We are now fully pricing in a hard landing and a recession in the bond market. Now remember, the bond market is smarter than the retail traders, okay? Most retail traders never touch bonds. They never trade bonds in their entire career. But the bond market in aggregate is widely regarded as the smartest market, largely because it is the big money, the central banks, that move the bonds around. And so with that as context, remember, okay, the bond market, once again, as I just said, is now fully pricing in a hard landing and recession. So whilst everyone else seems to be sitting here saying higher for longer, stock market's got legs, 18.6-year real estate cycle, and all of this stuff, okay, up only, liquidity is going to increase, bull market into the end of 2025. I'm even seeing some people calling for the roaring 20s, okay, a full 5-6 years of bull market before we see the next bear market and recession. Well, to that I simply say, once again, tell that to the bond market. The bond market doesn't agree with you, okay? The bond market is fully pricing in a hard landing and a recession, and meanwhile, everyone on Wall Street is saying everything's fine, soft landing is coming, and that is still most people's base case. And QE Infinity here is absolutely right, okay? Trust the credit traders. They get it right a lot more often than everyone else does. So whilst your favorite influencer on Twitter is saying up only, okay? Soft landing, big roaring bull market, welcome to the roaring 20s, okay? That is not what the smart money, that is not what the banks, that is not what the credit traders think. Take a look at this red dotted line that I'm just drawing over right now, okay? That right there is the recession threshold. At the hard right edge, we are trading below it, which is even lower than where we were during the C19 plunge. It's also rapidly approaching the GFC. It's already deeper than the dot-com bubble, okay? And all the way back here in the 87 crash. So really, really think about the implications of this, okay? Is this absolutely fine? I don't think so personally. Once again, I do say the bond market is trying to force the Fed's hand to cut here. And you might be thinking, well, is that good? That's bullish, right? Rate cuts are stimulative. Well, the reality is, if we just look back, okay, if we just look back at the last few times we saw this play out, once the Fed, in blue, starts cutting rates, okay, what happens? The stock market tops within a few months of the onset of that cutting cycle. It's the same here, okay? We see the Fed cut rates, stock market tops very soon thereafter and enters a big recession. Same back here, okay, stock market tops. So is this time actually different, okay? Because if it is, then we might see the Fed start to cut rates and this continue up well into next year. But again, the thing I am suggesting you at least consider is if that's what you think, unfortunately, the bond market does not agree with you. I had Andrew on over the weekend to give a masterclass in cycles. I actually learnt quite a lot. Andrew is very, very knowledgeable about cycles, so I highly recommend you check that video out if you haven't seen it already. That video has been very, very well received, judging by the comments. Andrew will likely be coming back on the show at some point in the not too distant future as well, once we've allowed some cycles to develop and play out a little bit. And I think Andrew actually helped me to solve a bit of a problem pertaining to the Bitcoin cycles. Something me and Kimazabi have been experiencing, and Andrew said he has as well, is that Bitcoin has thrown an unusual amount of wonky counts, right? Counts outside of the timing window during this bull market. It's been quite difficult for cycle traders to stay on top of Bitcoin versus something like the S&P 500 or gold, which has been more or less pretty consistent, certainly hasn't thrown any wonky counts that are outside the expected number of wonky counts, unlike Bitcoin, which has been a real problem child. I was also talking to Crypto El Prez about this, and I noticed Crypto El Prez is noticing a bunch of cycle inversions and early counts, and we were both kind of going back and forth and trying to figure out what exactly is going on here. I have also been rocking with this experimental 106-day count, okay, the pink arrows here. And one thing I noticed is if you put it on the weekly time frame and zoom in, what you'll notice is this is roughly a weekly cycle denoted by the blue arrow and the pink arrow. And if we count 2 pink arrows forward, okay, 1, 2, that gives us within 1 week tolerance a weekly cycle low. 1, 2, that gives us a weekly cycle low, okay? 1, 2, if this is a cycle inversion, we just forced an early weekly cycle low ready to move higher again, okay? So I've been rocking with this 106 count and trying to figure out how on earth is it that 106 times 2, of course, is 212, divided by a 60-day Bitcoin cycle gives us about 3.5 Bitcoin daily cycles in a weekly cycle. And this is kind of unusual. I've been thinking to myself, how on earth does this make any sense? Why is it that 106 times 2 daily cycles are giving us more alpha than trading 60-day cycles? Why is it that Bitcoin keeps throwing 30, 42-ish day cycles? None of this was making any sense to me. But having spoken to Andrew, Andrew pointed out that Bitcoin seems to like to complete 3 daily cycles and then throw a daily cycle low inversion around the half cycle low to complete its weekly cycle low, which of course means we get 3.5 cycles, daily cycles that is, in a weekly cycle, and also explains why we've had a whole heap of counts outside the window this cycle, why Bitcoin has been such a problem child for cycle traders. But this has been a very, very interesting revelation for me, having spoken to Andrew, having rewatched the episode me and Andrew did, and of course having consulted people like Kimazabi and Crypto El Prez. I think we're finally here to get back on track with taming the beast of Bitcoin from a cycle perspective. I think if we keep in the back of our minds now that Bitcoin likes to do 3 daily cycles and then a half cycle low or a shorter cycle inversion to complete its weekly cycle low, okay, armed with this knowledge, we would have been much, much better at catching all the weekly cycle lows. And of course, at the hard right edge, if this theory is true, then we are not going to make a lower low below here. We are going to turn this into a cycle inversion. This will be the weekly cycle. And of course, it will be 1, 2, 3.5 daily cycles to give us a weekly cycle. So it feels really, really good to be able to say to myself, I think between the hive mind, between the Camel Crew, we might have just cracked the code for cycles, okay? I don't think many people were out here looking for 3 full daily cycles followed by an inversion to give a weekly cycle low for Bitcoin. But like I said, armed with this new knowledge, I do believe we have found some hidden alpha. So well done to Andrew for spotting that. I have to give credit to Chemo and to Crypto El Prez as well. And I have learned something because I think I certainly need to pay a little bit more attention when the counts start to get thrown out as often as they did during this last Bitcoin cycle. A new piece of knowledge for the Camel Crew, 3.5 daily cycles, perhaps in a weekly cycle, something to keep our eye on. And if that's the case, okay, then we may well have just forced an early weekly cycle low. And of course, if that's the case, we probably just forced a weekly cycle low on a half cycle low inversion. So let's keep an eye out for that. Let's make sure we are well aware that we might not get that undercut into a perfect day 60 cycle low. And at the same time, take a look at this from Andrew, okay? Because if that really is the weekly cycle low, if we just forced that from a daily cycle inversion, then a realistic Bitcoin target top using a shift fork would be around 135K. Now, sit tight and you'll see just how realistic this is, okay? If it's to come by the end of September, we would be looking for a move of 175% in 8 to 9 weeks. So does that sound outrageous? Yes, except the 2 boxed regions on the chart that I'm about to show you match that move perfectly. So improbable, yes, but impossible, no. Andrew looking for that daily cycle low back test first, and then perhaps we can start this slingshot to produce one of these box areas like this of around 175% in 8 or 9 weeks. That would still give us a target of around 135K over the next 2 months. Super, super wild times to be alive. So for now, the big question is, if that really is the inversion, then the low should hold. The low should be in here. We would possibly be looking for some kind of back test like this of the cycle low over the next few sessions, followed by a big rip-roaring rally to catch hold of. A higher low here may well be me entering long and attempting to catch this 175% move over the next 8 to 9 weeks. Wild, wild times indeed. I think we're getting dangerously close to seeing a weekly cycle low and a tradable low come in for the precious metals. So particularly in the level 3 members section, I would expect to see some trades get put on this week, perhaps after we've seen the CPI prints, if not before. And of course for the stock market, okay, if that really is a day 44 low instead of a failed cycle, then what we should see is a little bit of a pullback and a breakout. Okay, something possibly akin to this, maybe a CPI shakeout, okay, hotter than expected data, more sticky inflation narrative, followed by a breakout, and I think we could probably get hold of some trades out of that. So looking forward to this. Something I think would be the path I would be very cautious about trading would be if we just continue this same trend, okay? If I draw a little rough trend line, if we were to do something like this over this week into resistance, I would be thinking what comes next, just based on my experience, is this. Okay, so something to keep an eye on. For now, objectively speaking, okay, we may or may not have a cycle low. That's to be determined, and we are still contained below resistance. The same is true for the NASDAQ, right? Are we going to get something like this and a big rejection and an undercut? Maybe. Or are we going to start to have that back test of the cycle low and then look to get a breakout? And if we do, of course, then we will have a nice tradable long thesis in here. I'm noticing oil also looking to give us that short setup, okay? A little bit of a squeeze, maybe a lower CPI print perhaps, and then short this thing all the way down to $30 a barrel. That's my thinking. Okay, so trade setups for the week. I think we can consider these called out well ahead of time. Okay, looking for Bitcoin to prove to me it's got an inversion. If not, we wait for a new low. Looking for the metals to give me a tradable and confirmed weekly cycle low. Then we're going to catch that. And for the stock market, as I said, you know, contained below resistance for now, but get out of no man's land. And again, you'll see the Camel Crew do what it does, which is catch the lows and trade the breakouts. And last but not least, of course, oil. We've been very, very patiently waiting for this. It's kind of ended up forming slightly different. Like if I grab my squiggle, it's probably... it went deeper than expected. Let's say roughly like this, okay? So, but you can see overall the shape is probably going to be not too dissimilar. Looking for a bit of a squeeze, maybe take the stops from here, and then where my short entry is, somewhere in here, I think it is going to be time to be looking for weekly cycle low failure, looking for chained left translated daily cycles that also fail on their way down to that next weekly cycle low. So pretty wild time to be alive. Like I said, plenty of trade setups and ideas there. And of course, if you're a level 3 member, you get notified in real time when we capture them. Other than that, welcome to the week. Welcome to Monday. I hope you're doing well in life. And until next time, take care from me. All the best. Cheers. Bye.